On August 24th, 2021, I built 3 portfolios for dividend income with different objectives. This video is part 2 or model 2 of the original portfolios I built, and it's an update on how they've performed since August of 2021. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, a.k.a. Mr. Valuation. This is an update video on the 3 model portfolios I built in August of 2021. In part 1, I reviewed the Model 1, and this part I'm going to view Model 2, and then finally I'll update Model 3. Now, all 3 of these videos were produced for dividend income and for investors with different objectives regarding how they could put together a different dividend income portfolio. They were also designed with some different strategies. Now, these aren't the 3 strategies I'm saying were the only ones that should have been used. These are just 3 strategies that I utilized of the many, many choices that I could have had. But most importantly, these portfolios were designed to meet specific investor objectives. Model 2 was more oriented towards future yield and future income and growth, where Model 1 was actually a current yielding portfolio. So in this portfolio, it was designed for the younger investor who might be looking at 20, 30, 40 years or more before they would actually start living off of the income. I always like to say, we work hard all our lives for our money, but once we get into retirement, it's time for our money to work very hard for us. And that was the idea of this portfolio, to something that could be started in your younger years as you're working towards retirement, and then when you finally got there, your portfolio would have enough size and enough yield to be able to meet your needs without having to sell any stocks. And that's a critical factor here, without having to sell any of your stocks. So let's go ahead and get into the FastGraphs Fundamentals Analyzer software tool and look at model number 2 that was built in August of 2021. Here we have a summary of model 2. The market value currently is $1,232,000. That's in a couple of years. It started out as $1 million portfolio. This portfolio has generated over $300,000 in total return, or gross, or 30% appreciation. The annualized rate of return has been 10.94%, and the current value of the portfolio would be $931,296. Now, what that means is this was originally built with $1 million, and we've received $68,000 in income with a current yield of 2.33. Now, Model 1 had a yield over 4% and generated more income than this one, which is what it was designed for. This one is designed for growth of income going forward. Now, the summary is for yesterday, these were the gainers: UGI, Cummins, Raymond James, Spire, and Lockheed Martin. The losers for the day were FMC Corporation, Whirlpool, Elevance, Amgen, and Best Buy. Now, these stocks, obviously, this is the 1 day's fluctuation. This is the change in volume for that day that they did. I just want to orient you towards this report. All right, when I look at the asset allocation, 25% of this portfolio was in mid-caps. Now, that's more than we saw in Portfolio 1, because remember, this portfolio was oriented towards investing in growth. Now, at this point, I also want to say I'm not managing these portfolios. Okay, these portfolios are unmanaged, almost like an ETF, if you will. With some management, they could have even possibly done better, or of course, they could have done worse. But about 74 or 75% of the portfolio is in mid-caps. In terms of diversification, once again, it's pretty widely diversified, except 41% of the portfolio was actually in healthcare. And as I said in the part 1 of this series, healthcare is where all the value actually is in the marketplace, or where there's certainly been a lot of value in the marketplace. So that's a quick summary of how the portfolio has performed. Now, what we're going to do is we're going to go into the holdings page here, and we're going to look at each of these stocks individually. We're going to see how these stocks have done, both based on total performance, growth alone, and income produced and income growth. Okay, so what I'm going to do here is I'm going to shorten the time frame, as I did in the other video. I'm going to do it to 6 years so that I include the August date that the stock was bought. Then I'm going to allow any dates on the tool, And then I'm going to go in here and I'm going to find 2021, and I'm going to go into August, and I'm going to go to the 24th. Now what that's done is that's listed the actual performance specifically and precisely from the day these portfolios were originally presented and built. So now when I go into the performance report, starting with Amgen, we're going to evaluate it next to the S&P 500 or the SPY ETF. And as you can see, Amgen has outperformed it on a price appreciation, and on valuation, it was significantly had better valuation the whole time, because valuation matters, and it matters a lot. Now, another point about these portfolios, and I might want to interject that here, is these portfolios were based on investing when valuation was sound. That to go back into Amgen here, you see Amgen's stock price was below the fair value line, or the orange line on the graph, which is a 15 PE. It was bought with a PE ratio at the time it was purchased of 13.26. The PE ratio is now 14.64, and you can see it did get as high as over 15 here just recently. But now again, this is a 2.5 year approximately time frame, which I might also add is not a long enough time frame to be evaluating a stock. Now, if I go to the S&P 500 here, the portfolio was built where that red dot is, and I want you to basically quickly get, again, a sense of valuation. The orange line is the fair value reference that S&P 500 ought to sell at. The blue line is how the market has priced it. Now, coming out of the recession of 2008 and 9, we see that it traded at a 15 multiple. This would have been a great time to be investing in the S&P. Then we saw the PE get high up here to about 18.8, and it stayed that way for several years. This is one of the longest running and most aggressive bull markets I think I've ever experienced. But then by August of 2024, the valuation had got extremely high. And at that point, I was pointing out that how could you build a dividend growth portfolio in such an overheated market? And so what we did was we looked for individual, fairly valued dividend growth stocks that had good growth potential, decent dividend yields, and the ability to grow those dividends over time. All right, and on the concept that it's a market of stocks, not a stock market. So even though the market was overvalued, there were undervalued or fairly valued stocks to be found. So let's go on. Let's finish going through these constituents of the portfolio here. The next one I'm going to look at is Ameriprise. And again, I want you to see that Ameriprise performed extremely well. If I use my calculator here, it's averaged over 21.5% annualized. But if I go into the pure portfolio performance result and look at it, there's the 20.72%, that I showed you earlier compared to the stock market of only 7%. The dividend growth has been over 9% per annum, and the S&P's dividend growth has been 5.32. I want to emphasize that as well, because we're looking here for not just growth of capital. We want to generate a total return at the end, but we're also looking for growth of the income. And this one is clearly outproducing the S&P 500 in terms of growth. But now the total dividends were just slightly better than the S&P 500 because, again, this is not a high-yielding stock at the time we bought it or currently. It's only yielding 1.25% today. And it was around that. Now, it's an A-rated company with 53% debt, has an earnings yield of 7%. It still meets my minimum threshold of 6.67%. So I would still call this undervalued, or I'd call it within the valuation corridor, because the market has typically applied about a 12 multiple here. Let's move on. I just want you to get the picture. Now, Best Buy has been a disappointment. Earnings fell quite a lot, almost 30% in 2023. And this is a fiscal year of January. And then another 10% by January of 2024. And then they're expected to fall another 5% before they start growing again. So this would be one that we have to be a little patient on. It's one of the losers in the portfolio, if you will. Now, having said that, if we look at performance and go into the performance report, remember this is a dividend income portfolio. This stock actually did produce almost twice the dividend income of the S&P, and income growth was what it's about. Its dividend has grown at a very rapid pace compared to the S&P. But now, if I look at that from a practical point of view, Best Buy is an underperformer in the portfolio. Going through this further, BorgWarner is another disappointment. where we had some earnings issues, but the stock is expected to recover very strongly. It has a 1.27% earnings yield. If I quickly go into the performance, then you see that it's outproduced the S&P just ever so slightly in dividends. It's underperforming it in capital appreciation and total return so far. And the average dividend growth rate has actually been negative. So this is why you diversify. You diversify because you can end up with stocks like BorgWarner that don't work out as you expected them to. Now, Cardinal Health, on the other hand, was a very undervalued stock at the time, one that had been undervalued for a lot of years, and this has been a really super performer in our portfolio. And once you buy it undervalued and the fundamentals work, and I want to make that point, the reasons that Best Buy and FMC and some of the other stocks in this portfolio didn't perform was because their fundamentals didn't meet expectations. That was the problem. It wasn't the fact that they were overvalued or so at the time. They were actually undervalued at the time, and like FMC performed very well until it ran into a 49% drop in earnings in 2023. Fundamentals matter, and they matter a lot, as I often say. Now, going back in the portfolio, before I go any further with any of these stocks, I want to basically hit this gain and loss column, because I want to, rather than just try to point them out in advance individually, of this portfolio, we had 1, 2, 3, 4, 5, 6, 7 stocks that underperformed or didn't perform negatively. And then we had the rest of the stocks in the portfolio have performed, the other 13 stocks, if you will, were better than what we expected them to. And that's why you diversify, because I also want to point out, even though the S&P 500 was overvalued, it also had underperforming stocks in the portfolio. Now, going back into the holding section here, let's kind of move quicker now. You get the picture. Here's Ingredion. It's been a very good performer, 2.68% dividend yield. We've had a very nice rate of return on this stock over the period of time. It averaged over 14%. That's almost double what the S&P during this time frame. And if we look at performance here, again, you'll see that you had 14% total return versus 7. You had $816 in income versus only $300 in income in the S&P. Here's Lockheed Martin. Lockheed Martin has outperformed as well. And once again, just to keep it simple and to move more quickly here, we had a 12% return versus a 7% in the S&P. So once again, the stock has outperformed, and we've also gotten good, decent dividend growth. We went from $11.40 to $12.15 and expected to be $12.65. So we're getting the growth, and by the way, I still think it's too early to be measuring this portfolio. Here's Merck. It's also been an excellent performer. This gold line is the cost basis. You can see the stock price is well above it, and it's given us a real good dividend yield and a good level of dividend income. Omnicom Group has been another one that's been outperforming. As you can see, the performance, just to put it into perspective again, we've had about 14% versus around 7% for the S&P. And again, we've had good dividend growth. And again, if I go into performance, and this is how you can use this portfolio management tool, by the way, we had almost $1,000 in income versus $361 in the S&P 500. So I want you to basically take note of the fact that not only is this outperforming on a total return basis, but it's actually producing more income than the S&P, even though it was not designed to be a current yielding portfolio. It was designed to be a portfolio that grew income over time. And again, I think it's premature to be measuring that at this point. I'd like to see a 3 to 5 year minimum holding period, and 5 years or more is really what matters. The reason for that is it takes time for a business to generate the growth in the business that actually eventually brings the stock price and the dividend income to the investor. Companies only report quarterly, and as the earnings grow and the sales grow and the cash flows grow, the dividends will grow with it, and the stock price will eventually follow. Looking here at Science Applications International was another one. If we look at the performance of this one for this time frame that we've owned it, it's averaged almost 19% a year. It's been one of the better performers from a total return point of view. really outperformed the S&P, and it's been significantly at less risk. When you see the blue here, the company valuation below that of the S&P, this is also a picture showing you that there's less risk owning this stock over this time frame than there was in the S&P, which was overvalued. And once again, we have almost a 19% annualized rate of return, 15.7% growth versus $11,096, and we had $444. Even this one, which was more growthy, outperformed the S&P, and it worked out extremely well. And the dividend growth has been decent as well, although it wasn't showing up in that report for some reason. And the next one is Spire. Now, this is actually a utility stock. It's kind of underperformed the market a little bit, but again, it's designed because it gave us a little bit of a yield kicker. It has 5% current yield right now. It was over 4% when we bought it. And then Tyson Foods had one of the earnings issue. This is ones that we talked about. UGI was another one that basically has dropped precipitously in value because of earnings issues. And then Whirlpool was another one that had earnings issues. It's kind of interesting that they're all towards the end of this. Now, if I go ahead and adjust this and hit maximum here, what I want you to see is how Whirlpool was really doing extremely well, and then it's run into several years now. It'll end up being 3 years of negative numbers, but the forecasts for growth going forward are better than they've been, or still negative. So Whirlpool could end up being a major loser in the portfolio. But anyway, that's a quick look at the portfolio that was built in August of 2021. Going back to the summary, it has produced in aggregate about a 3% advantage over the S&P. It's produced significantly more income than the S&P. Its current yield is about the same, but it's had faster dividend growth. And again, this portfolio was designed to grow the capital and the income over time so that when you got to a retirement age, if you were a younger investor. But value investing works, and it works quite well. And again, we're only 2.5 years into this process, and I think we need more time before we can really judge this. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. This is the update on the model, on the second model, and I'll do another video coming up on the third model, which was more of a high yield, where I overweighted high yield stocks, and it was to get maximum yield on the portfolio, and we'll see how it performed when you see it. Now, the links to these original models are at the bottom of this video, so you can go back and revisit those models in those original videos that were produced in August of 2021. Thanks for watching. If you liked the video, give me a like, ring the bell, and also just take a real hard look at FastGraphs, the fundamentals analyzer software tool, the value investor's best friend. Thanks for watching.